All right, let's jump right into this explainer. Today, we're uncovering the hidden architecture of the financial markets. The stuff that's probably been working against you. We're zeroing in on a concept called inducement. Basically, these are highly deliberate price movements, totally designed to lure retail traders into awful entries right before the real move actually happens. If you've been trading for any length of time, trust me, you felt the sting of this, even if you didn't know exactly what to call it. I mean, think about it for a second. Have you ever bought perfectly at a textbook support level, gotten stopped out by, like, a fraction of a pip, and then watched in absolute agony as the market just rockets exactly to your original target? Yeah. If that's you absolutely need to hear this. Because it feels personal, doesn't it? It feels like the market knows exactly where you hid your stop loss. Well, in a way, it actually does. Part 1, the retail trader trap. This is how institutions win. Let's pull back the curtain on this deeply frustrating phenomenon that retail traders deal with literally every single day. So here's the harsh truth. That painful loss you took, it wasn't just bad luck. It was a highly engineered trap set by large institutions. See, the major players, the smart money, they can't just casually enter a trade with hundreds of millions of dollars whenever they feel like it. If they just clicked buy, the slippage would be massive, completely ruining their entry price. So they desperately need opposing orders to fill their massive positions. They need liquidity. And your stop-loss orders, that is the exact liquidity they are hunting for. Just look at the stark difference in mindsets we have going on here. On one side, you've got the retail mindset, impulsive, chasing those textbook chart patterns, and aggressively looking for breakouts. But on the flip side, you have the smart money mindset. They're incredibly patient, they're actively seeking out liquidity, and they are literally engineering traps. So while retail traders are emotionally jumping into what looks like a super clear trend, smart money is just patiently building an illusion specifically designed to grab the retail trader's cash. Section 2. What is inducement? Let's define the trap and really get into the specific mechanics these institutions use to construct this whole illusion. And that brings us directly to inducement. Now, I want to be clear, inducement isn't some wild internet conspiracy theory about brokers plotting against you in a smoke-filled room. It's actually a structural necessity for the market to function. It's a completely deliberate price move by institutional players to lure traders into thinking the market is heading one way. Big banks simply cannot execute their massive orders without first inducing smaller traders into taking the bait, triggering a whole cluster of stop losses, and then using that exact liquidity to fuel the actual direction they wanted to go all along. What's really fascinating here is how clearly we can separate the trap from the fuel. A lot of traders confuse inducement and liquidity, but really they're two halves of the same coin. Inducement is the deceptive process. It's the fake out, the false signal, that trendline break that just looks way too perfect. Liquidity, on the other hand, is the outcome. It's the resulting cluster of all those triggered stop losses and pending breakout orders. So inducement creates the liquidity, and the liquidity grab consumes it. Make sense? Okay, moving to Section 3, Anatomy of a Grab. We're going to do a step-by-step breakdown of how this builds into such a devastating trap for the uninformed trader. Every single institutional trap follows this exact chronological blueprint. Step 1 is temptation. The market forms a really tempting structure, maybe a beautifully clean double top or a rock-solid support line. Step 2 is accumulation. Retail traders spot that textbook setup, they jump into the market, and their stop losses start building up right above or below that level. Step 3, the sweep. Institutions spike the price right through that level, ruthlessly triggering all those resting stops. And finally, Step 4, the real move. Having collected all that necessary fuel, the price aggressively reverses and takes off in the originally intended direction. But you're probably wondering, how do I know if a breakout is actually real or just a trap? Well, the secret is volume. As one of our sources from EBC Financial Group points out, volume is the oxygen of inducement. Without real participation, there is no trap. You've got to remember that a sudden surge in market participation with absolutely no actual price continuation is a massive red flag. Basically, if price breaks a key level on high volume but then instantly stalls out and fails to push further, an inducement trap is highly likely forming right in front of your eyes. Let's jump into Section 4, Inducement Patterns. Let's talk about actually spotting the trap on a live chart. Because once you see these blueprints in reality, you will never look at price action the same way again. Just take a look at how the market creates a perfectly clean double top right here. To your average retail trader, this looks like an amazing, screamingly obvious resistance level. It's practically begging you to hit sell. So they lure these retail traders into placing short orders, and naturally, where do those traders put their stop losses? Right above that double top. By engineering these perfectly equal highs, smart money has intentionally built an incredibly rich liquidity pool just waiting to be harvested. Now watch what happens next. The price briefly but sharply pierces straight through that supply zone, completely taking out the double top. This right here is a classic fakeout. It triggers all those buy stop orders from the trapped sellers, which hands the institutions the exact liquidity they need to sell their massive positions. And then immediately after the sweep, the price aggressively drops in the true intended direction. The retail traders are left sitting there stapped out, watching the market do exactly what they predicted it would do, just entirely without them. A super famous time-based example of this is called the ICT Judas swing. This happens a lot during major session openings, especially right between midnight and 5 a.m. New York time, as the London session is kicking off. What happens is, the market falsely breaks out of a really tight Asian session consolidation. It actually gets its name, the Judas swing, from the Judas goat that they used in ancient times to lead the rest of the herd to slaughter. The market totally fakes a move in one direction, to slaughter the early buyers and sellers, grabs their liquidity, and then heavily reverses to establish the actual true trend for the day. Section 5, trading the real move. Because now that you can see the matrix, it's time to stop being the prey and start trading alongside the predators. So how do we actually use this? To correct your trading mistakes, you absolutely have to follow these golden rules from our sources. First, actively mark your previous swing highs and lows. Those are your liquidity pools. Second, and honestly, this is the most important one, you must patiently wait for the sweep to happen first. Don't trade the initial breakout, trade the reaction after the fake breakout. You want to look for a clear, aggressive displacement back in the opposite direction. Third, always check your higher time frame context. Look, a false breakout on a 15-minute chart means literally nothing if the 4-hour trend is pointing the exact opposite way. And finally, verify with volume anomalies. Look for those high-volume sweeps that result in instant rejection. Learning to read inducement correctly totally transforms your frustration into genuine market insight. You stop reacting emotionally and you start observing systematically. So I'm going to leave you with this final, vital question to memorize before you ever click buy or sell again. Look at the price action and ask yourself, who is being induced right now? Is it me or them? Because remember, if you can't tell where the liquidity is, you are the liquidity. Thanks for joining me on this explainer. Keep your eyes open and trade smart.